and this original episode will be broadcast on the last day of the third quarter. Imagine we have completed 3 quarters of the year in the markets, and it's been a rough year, very torturous. So let's take some time here, summarize where we are, have a look at the secular uptrend. Also, can the stock market rally in the fourth quarter? What do we need to see to be able to have a fourth quarter rally? And then also a historical analog, which is a cautionary tale. Let's get started. First off, ChartCon 2022. I have the great good fortune to be one of the presenters at ChartCon this year. I'm very excited about it. I'm going to be on a panel where we're going to discuss risk management. I'm going to discuss it from the perspective of the Wyckoffian orientation, which I think is very unique and special. And also we have a great panel with some very, I think, useful risk management discussions techniques that are going to be presented. Also, I'm going to be talking about industry group sector analysis, and I'm going to show you a scan that you can do to show you best leadership in the market. I think it's very valuable, and I really would like you to be there. And finally, I'm going to do a fireside chat with Martin Pring. Martin is going to be my guest, and we're going to talk about the breadth of Martin's career, the highlights. It's going to be fantastic, and I'm really looking forward to it. So please join me. Let's start here. This is a chart that I put up, and you'll be able to go back and actually capture this chart in a blog that I wrote on August 25th, Stocks at a Crossroads. Now, at that time, the market was right in this area here where it was up against this very important downtrend. Also, the 200-day moving average was being touched. It was throwing over this resistance area and was in a position where it was needed to be able to stop, pause, and then continue its uptrend, or we were looking at this as an analog for what could happen here, but on a larger scale, because this is a bigger construction, bigger chart area. And so we had fulfilled this yellow box point and figure count, and we had gone into the area of that, almost reaching the upper edge of the count objective range. And then sure enough, it just fulfilled the lower count, started to turn down, and this is where we have ended up at the end of the third quarter. So we're all the way back to the lows that we made at the end of the second quarter. So this, I believe, is the effects of window dressing by institutions. They have continued to sell stock, reduce down their weak holdings, and we are now probing the lows of the year. So what do we need to see to be able to suggest that the market is oversold, ready to attempt a more important rally from this level? Because this has been a very significant decline, not quite as bad as the decline that started here from late March into June, but a pretty severe decline, and it put us back on the lows. So notice also that we have a throw under and an oversold condition. Again, like we did in June, this could be an extreme exhaustion, and that there is a climax here, which tends to demonstrate that there's some kind of a selling climax event taking place. But we will only be able to confirm that, as was the case here, with a rally, which we would call an automatic rally. So we will watch that closely as we go through time. Here now, let's turn to the secular trend, also very, very important. And the secular trend goes back to 2009 and has been an epic advance, just incredible bull market. And so we can see here with the S&P 500, and we showed this at the time here on Power Charting and other places at the throw over, and these were my notes from that time, is that the upward stride was intact. We had a reversal. We were watching for a reversal off this overhanging supply line and the upper Keltner channel. This overbought condition was in fact reversed, and we had argued that if it did reverse back into the channel, that it could go down quite speedily back to the bottom of the channel. It has done exactly that, and it arguably is the most severe decline of the secular bull market. Now, as you can see, this is below the secular uptrend and is now at risk of just basically falling out of its secular uptrend as it did in 2008, 2009. And so I've drawn a red line over here, a red arrow, which shows that if you do get a breakdown, you can go to the bottom of this Keltner channel, which then can continue to decline, which it did. Now, this is a very severe bear market back in 2008-9, the Great Recession. But look how far we are at this time from that lower Keltner channel area. Is it achievable that we could get to that? Well, it's possible, and then this is where the support is at 2,800. I'm not predicting that, but it's something we need to keep in mind, that there could be a secular shift taking place in the market. Here is another secular uptrend line, which goes back to 2010. This is the Nasdaq 100. Nasdaq 100, look at the persistency of this uptrending channel throughout, and then a big bulge over the top in 2020, 2021, which was the climactic blow off of the secular bull market in my estimation. You can see here the touches of the lower trend channel, and each of those held and produced a very important rally back up to the top or overbought supply line, and we are now very, very close to touching that again. And so this will be interesting to see. So the Nasdaq 100 is not breaking down yet out of its secular channel like the S&P did, we saw in the prior chart, but it can in effect break down. We just need to watch it very closely and look to see whether a rally can begin from this area. Underneath, I put a very, very long-term put-call ratio chart. This is a 10-week moving average, which I consider to be just a fascinating chart, because look at how the sentiment oscillates between extreme pessimism, lots of put buying, extreme optimism, lots of call buying, and how this coincides with important highs and lows. Here, something unique happened in 2020 after the COVID rally began, so to speak. There was a bulge through into the extreme optimism call buying area that lasted about a year. And this to me was like a year-long bullish extreme climactic surge. Up here I label it overbought and throw over through this whole area with lots of call buying throughout. And now we're working our way back up to the pessimism level. But note, we have not yet reached the level of pessimism that's normally associated with a good low in the market. So this could be also a reason for caution, because we don't yet have the amount of pessimism that would suggest that we could have a good low. Here is some breadth indicators. This is the Nasdaq Composite. Nasdaq Composite Advanced Decline Oscillator. This is a 60-minute on the left, daily on the right. And let's blow this up. So big downtrend has occurred through this area, and it's a downtrend that has produced a number of oversold conditions, and we now are reaching oversold again at the end of the quarter. What we would like to see is we would like to see divergent behavior. As we saw here, you can see that lower lows were made in the index and higher lows have been made throughout, which is signs of a local green shoot, bullish condition that can lead to a more important rally. This was a decent rally, not great, lasted really just a couple of weeks. Now, on the daily basis, here are green shoots. These green shoots, this is January, February, and this produced a series of divergent characteristics that gave us this rally in March. And then the more important rally was the May-June lows, the important May low, which was a sentiment low. The June low was lower. Look at the divergence here, and then higher lows throughout as we got a pretty good rally thereafter. So we can't yet say that we have that here, and we will be keeping an eye on that as we go into the new quarter, whether or not it's possible to develop some green shoots that could produce a more important rally. So far, I'm not seeing anything that suggests that we have that yet. Here, you can see the bullish percent on the Nasdaq comp over here, this orange line, and it is probing the lows. 25% of stocks have bullish percent confirmation, very low number, very minimal breadth. So, but that also can be an oversold condition that can produce a more important rally. Now let's turn to the, here's the Nasdaq on the left. This is percent of stocks above their 50-day moving average. Another form of breadth. Note, only 14% of stocks at this time are in a positive trend above their 50-day. That is a very, very low reading, which is an oversold condition. And we had a very oversold condition in May. And so here we have the potential for an oversold rally. But look, in June, here's the May low. In June, we had a lower low in the index on the Nasdaq and a higher low on the percent of stocks, meaning that more stocks are getting above their 50-day for a rally potential. We are not yet seeing that. We expect to see that if we're going to get a good rally in the fourth quarter, and we don't yet have that divergent behavior. We will wait, stay in the moment, pay attention to what the market is telling us, and let the market show us the way, either higher or lower. Now, here's the 200% of stocks above their 200-day on the New York. And note that and this moves much slower than the 50. You know that you'd have to get above the 50 on a breadth basis, a number of stocks, before you're going to get a breadth divergence in the number of stocks above their 200. They got to get above the 50 before they can get above the 200. You will note here that there is a divergence between June and July, and a meeting of the lows in July on the New York composite. So this is a divergent character which produces a more important rally, which is the rally into the August high. So here, note that we are deeply oversold again. Only 14% of stocks are above their 200-day. That's extreme pessimism. Now, in ChartCon, I'm going to show you a technique using the scanning engine, a very simple scan that is going to be able to show you the leadership, the stocks that are attempting to lead the way, not just the 14% of stocks that are up. And I'm not saying that you should buy them, but I'm saying, how do you find out which ones they are? Especially when the market starts to broaden its breadth characteristics in a bullish way. We want to see which stocks those are. I'm going to show you how to do that at ChartCon. So I'm very excited about that presentation. Now here, this is the put call, recalling back to that big bulge. Well, here's that big bulge in the put call ratio back in 2020, 2021. And we are going to see here that we're back to a much more normal reading up here at these levels. This is more typical, but look at, let's blow this up again. Look at the extreme move of put buying that occurred here just in the last few days. The red line is just daily plots. The green line is a 10-day moving average. So the 10-day is very high. Actually more pessimism, more put buying than at the May low. But now you can see also that the single day reading is very high compared to the May-June readings. So that also is a measure of extreme pessimism. That can, in fact, be a good sign that the market is so pessimistic now that it's attempting to make a good low, or may start to make a good low. The CNN fear and greed, which is very interesting to follow. This is as of today, Thursday, the 29th. So right at the end of the quarter, right on cue, a reading of 14, very low reading. Got down to, in April, May, the low reading was like 4. So even lower than it is now. But the fear and greed is picking up an extreme level of pessimism at this time, and you can see the S&P is probing lower lows than it did in June. So the pessimism is very thick at this time, but we need to confirm it with positive action in the market, which is those green shoots that we were just talking about, and also price structure in the indexes themselves and the individual stocks. Now, turning our attention to the bond market, let's look at the 20+ year TLT Treasury bond ETF. This ETF is a great proxy for how long-term treasuries are acting. Here is the distributional top in the TLT that was made back in late 2021. And this actually is July. Here's August, the number 8, September, the number 9. Note the upthrusting action. This is referred to as an upthrust after distribution right here, and then an outright failure all the way to the bottom of the support area. That is what a classic upthrust after distribution does. And we had one of those in the long-term treasury bonds, which then produced a cascading decline for all of 2022 so far. And note this hinge that we have here, and this is underneath the ice, we call it. No ability to rally, just consolidates under the ice. We are able to build a count across this distribution area, being very careful not to overcount distribution, but I think this is really a good count. We count the test from the breakdown, the sign of weakness, up to the test at 17 across. This is a 3-box reversal chart. Counts all the way from a high of 152 down to 101 to 91. Substantial decline for bonds. Well, now we have a redistribution over here. And this one, I think this is the proper count, because here's the high, here's the weakness that follows, and then a rally up to a test and then a failure. This counts down to 99. Look at the low we just made, 101. And so this is fulfilled. This count, which is 101 to 91, this count to 99 is close to being fulfilled, and may in fact go down to that level. We may be able to get all the way to 91. Hard to say. Also keep in mind that I do think that it's a legitimate count to count over to this area here, which would add 8, 9, 10, 11 total boxes across. and that would give us a much lower price. But I do believe that this is a good conservative distributional count that is a validated count. And so let's see if these two confirming counts do come into play. We need to see a cause built for a rally in bonds, but we'll be on the lookout for a potential bond rally. Here is a chart of the US dollar. This is an upward trend that goes all the way back to 2014-15. We have talked about this chart in the past in various forms, this upward channel. Note what's happening now. Big climactic surge above the top of the channel in the most recent monthly bar. This is monthly data, and you can see here that we have thrown over the top. Will we come back into the channel as was the case in 2020? We'll see, and whether or not the dollar is about to pause or possibly reverse, and that could have a positive effect on a number of other markets. And also a very strong dollar is very stressful to the other countries. So with that, let's look at our analog, the final thing we'll do today. And I just want to show you here, this is the S&P 500 2018-19. We're looking at daily bars. Keep that in mind. Very important rally up into what? The end of the third quarter. Magic. And so then a just change of character decline. Look at this. From the October high to the December low, the market is just down, down, down. Has a redistribution across this area. We will highlight that. That area is important. We will count this on a point and figure basis because it gives us potential objectives. But also I want to illustrate that there is a commonality between what's going on now and what happened in 2018-19, and it's a cautionary tale to be sure. So here is the count that I had just described, and look at how that count beautifully went down into the 2350 area, 2450, 2350 objective range, and that was the low for the decline, which came right at the end of the quarter. And the point I want to make is that look at how in 2 to 3 short weeks this cascading decline went through this area and just broke down. And this is the thing that I want us to be very, very aware of, is that we are now in a place where we are at the June lows and came to this level, made a slightly lower low, attempt a rally, which is a rally under the ice. It was poor, brief, narrow, and then it just cascaded lower. This is the risk that I think we face. I'm not predicting it, but I think that it's a very real possibility. Now let's turn our attention to comparing that 2018 period to today. Now, you're seeing here on the top chart the daily chart of the S&P 500, and underneath the weekly chart of the current market. There are similarities. You can see into the end of September into October, the market is trending higher. Then in 2018, you have a cascading decline that goes from the beginning of the quarter to the end of the quarter, fourth quarter 2018. Now we're looking at the year. Right at the end of 2021, we have an important high. We've been breaking down. It's possible that we could have all of 2022, high to low, be a down year and have declines all the way into the end of December. We have to keep that in mind, especially with the Fed being as tight as they are at this time. Now, let's look at and compare these periods. We can see here that there's important parallels. It's not a perfect analog, but we see lows occurring. Here's a low, here's a low. Here's a high, here's a high. and then an intervening low, and then one final high before a cascading downward. One final high before a cascading downward. And we see that at this time, we are touching the lows of June. So this is a perilous place to be sure. A rally attempted at this point, and this rally was very short, shallow in duration, and then cascaded down to new lows. So here we can see the same thing potentially. We could have a rally here of a shallow, narrow nature and very brief, and then another decline in the fourth quarter. And this area here could easily be broken down. With the Fed being as tight as they are, this is a very real possibility. We just have to follow the market and let us tell us where it wants to go. Here is point and figure counts. This yellow count here is this yellow area, which goes 3,700 to 3,400. We have fulfilled that count, actually did it in June. Now we have in the green box, we have another count that across this area goes 3,550, 3,350. And so we have the potential, as was the case in 2018, to go down to lower lows, to lower price objectives. And so we want to see those green shoots develop right here, right now, and give us the position for a more important rally. Otherwise, if we get a very shallow advance, very brief, we have to prepare ourselves for the possibility of a cascading decline to these lower low objectives. So with that, I will say so long. Thank you for being here. See you at ChartCon. Take care.